Traditionally, how insurance companies thought about investing their assets is they've typically bought large collections of liquid corporate bonds and a very small allocation to less liquid assets such as mortgage loans or private placements, and that's really changed over the last decade.
So in the past, they didn't have much choice but to buy liquid corporate bonds. That was what was available to them. With the rise of private credit, with the rise of alternative asset managers to some extent, that investment universe now, that menu of things they can choose from, has expanded meaningfully.
So on the one hand, you increase the size of your investment universe, which is a good thing for diversification. But this idea of matching your asset portfolio against your liability portfolio really demands a different type of asset mix. And I kind of like the idea of actually broadening the investment universe, but actually improving the quality of the assets that you're selecting as you broaden that investment universe, which is a very different way of sort of thinking about the historical construction of life insurance company portfolios.
Yeah, and you've really hit the nail on the head with that, Raj, is that if you can achieve higher returns in the portfolio, that benefits the policy owner, but only if you're either holding the risk level or you're actually reducing the risk. If you can earn a higher return on the portfolio, whether that's within a corporate bond portfolio, which is one form of diversification, or even better, by moving into other types of assets, other asset classes that have lower correlations with those corporate bonds, you're actually de-risking the portfolio by doing that.
So from my perspective, as a CIO, I love the idea that within broad pockets of structured asset portfolios, you get diversification of issuers, you get diversification of cash flows, and they're not all homogenous.
And we can even take that one step further, right? We can say, is this portfolio of structured assets, of things that we're doing in these less liquid, less opaque markets, are these actually going to outperform? So in this instance, what we're saying is that the return of principal, the payoff of the bond is better because the incidence of default is actually lower in this space. So you're getting a higher yield and you're having a lower default rate in the portfolio.
So think about the liabilities themselves are not like bank deposits. They are sticky, they're stable. You promise to lock your money up for a period of time. That allows you to think about an asset that matches that stickiness of that liability.
The nature of deposits in this day and age, when you can move your deposits on your phone, is causing a rethink of the way the banking industry works. And so the ability to migrate those assets to a balance sheet that's better able to hold them to term is what is happening. It's also, enhancing the returns of the insurance companies, and as we've discussed, it in some ways is risk reducing, right? Because it's enabling those insurance companies to diversify those corporate bond portfolios into other types of assets. Equally less risky at the individual asset level, but collectively much less risky at the portfolio level because of the diversification benefits.
Yeah, that opportunity to kind of enhance your asset portfolio, sort of given sort of the travails of what banks are going through right now, I think it's really kind of a game changer.